Hey everyone, welcome back to another session. Just a quick sound check and then we can get started. Hope everyone is having a great time towards the end of the year. Few surprises here and there. Okay, audience, since we get on my side, let me know if there's any issues. We are going to get started with a quick general advice and risk warning disclaimer. Note that any advice given is deemed to be of general nature, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times, you should consider the appropriateness of the advice before you act further. CFDs and Forex are leveraged products that carry a high level of risk and are not suitable for everyone. You can lose more than your initial deposit, so you should ensure CFD and Forex trading based on your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. Okay. As per usual, any requests, do type it in, but there are a few things we need to talk about. Obviously, we need to talk about the yen, what's been going on here, and the shift from Bank of Japan side. So let me explain a little bit on what's really going on. So let's take a look at the 10-year yield. Right, here's the Bank of Japan 10-year yield. I'll get rid of the stochastics. We don't need the stochastics. The line at the bottom here, that's the Japanese yen, to just to give you a comparison between the two, because I think a lot of people are mistaking it as oh, is it time for yen to strengthen and stuff like that. So let's take a look at the previous cap. So we have 0.25 and negative 0.25 for the cap here. So let me just get that in there. And I'm just gonna highlight a little bit on what's really going on. So I'm gonna zoom out. I'll shift into the weekly chart so you guys can actually have a look on what's really going on. So this is the cap, right? This was the previous cap done by Bank of Japan. It was a 25.25% yield cap, right? 25 basis points yield cap. This was just I believe it was yesterday. The cap was raised. So we got a new cap at 0.5, and it doesn't take long for the market to get there. So we've got 0.5, right? That's 50 basis points. I'll zoom out a little bit and show you what's really going on here. Okay, so the negative 25 cap, that was basically in place for I don't know how long. It wasn't really enforced. It was basically just a cap there. So what this cap means was that the JGB yield cannot go down more than 25 basis points below zero. Zero was the target line. The 25 basis points cap, that was basically what was enforced this year, right? That's when we saw the Bank of Japan intervene. I believe that was around June, July this year. That's when the Bank of Japan started their bond buying program to bring the yield down. Now, bond prices and yields are inversely related, right? So if we have a rising yield, we actually have a lower bond prices. Now, lower bond prices, are they good? Are they not good? So we got to think about this as this is unlike the currency market, right? The bond market is completely unlike the currency market. They're not one and the same. Could they be an indicator of some sort? Yes, but they're not the same market. They work differently. They have a different mechanics. They are designed differently. Now, Bank of Japan started the bond buying program. The Ministry of Finance in Japan was actually the one that comes up with the bond to for investors to buy in, right? So right now, more than 50% of the Japanese bond market, or more than 50% of the JGB bonds is actually owned by Bank of Japan. So you have to treat this two as separate entity. We've got the government, we've got the central bank, right? So the central bank is buying what the government is coming up with. Bonds are basically one way for a country to, I guess, earn revenue, not revenue in a sense, but this is how they raise funds, right? So if you guys know how startup works and stuff like that, or how a company works, they need to raise funds. The government does need to raise funds as well. Right. So anyway, looking back at this 0.5, right? The last time it was at 0.5 was basically 2015, 2014, I believe was when it first dropped down below 0.5, right? So 50 basis points. This is the highest ever since, 7 years ago or so on the bond market. This is right now capped at 50 basis points. So we are pretty much at the limit, right? Once this happens, once the 50 basis points line has been reached, Bank of Japan is going to come in and they're going to start buying bonds, right, to bring bond prices up, bring the yield down. Okay, so this might sound a little bit confusing because on one side, the Ministry of Finance in Japan is trying to push is trying to boost the Japanese yen. What Bank of Japan is doing, it's really trying to limit how strong the Japanese yen would go, right? So in a context, in the simplest form, you actually have this kind of push and pull. Now, the reason why this yield was implemented, all right, I'll be honest with you. We just talked about it on Monday. I did talk about this on the Outlook. There were some issues going around on Monday about Bank of Japan potentially shifting the way they do their monetary policy. This is a baby step towards that. So instead of immediately hiking interest rates, this is more like a test on how the market would react. All right. So the yield cap was pushed up to 50 basis points. So that allows more room for the bond market to move. That's basically it. What it seems to be doing is that gradually this cap is going to get lifted, right? Eventually there's not going to be any cap on it. The yield could go up like crazy. That's when the Japanese yen would go up like mad. If there is no increase in the yield cap, when Bank of Japan start shifting away from their what they call ultra loose monetary policy, right? No tightening at all. This is a really more of a baby step, right? It's not really the Bank of Japan tightening the monetary policy or anything like that. This is still ultra loose, right? This is super loose. If they don't do this right now, when they start shifting away from the ultra loose monetary policy, which is supposed to be in April after Governor Kuroda steps down, then the market would be in a much bigger shock. Okay, so do we expect further yield caps? Do we expect the yield caps to be increased a lot more? Think about it as a rubber band, right? At this point in time, it just cannot exceed 50 basis points. Every time it touches 50 basis points, Bank of Japan is just going to start bond buying just to maintain that yield at 50 basis points. Eventually, everyone's just going to tire out and just abandon the bond market. That's basically what's been going on throughout 2022. Okay, so we didn't talk much about this unless you're specifically trading the yen crosses. You probably wouldn't know about this, but the impact from what happened yesterday was. This is released during a period of low liquidity and low volumes in the market. So that's probably why you see more of a one-sided push on the yen. It's as if the yen is gaining strength overnight, like significantly. Is that the case though? If you take a look at how prices reacting to what happened yesterday, it was actually really flat. Today was actually really flat. If you take a look at the range on the dollar Japanese yen intraday wise, it's actually really, really small. So we have about that. Is it small? Yeah, I would still consider that to be small. Let's take a look at the start of the day, which is actually here. This is actually the range, right? It's actually within 100 pips or within 1 yen. So yesterday was much of a shock, right? We see a significant drop in the market, but the yield cap has been reached. We have achieved that 50 basis points mark. So whatever Bank of Japan does next month or so, if they increase the yield cap to 75, I can assure you within a period of 24 hours, it's just going to hit that 75 basis points cap. Okay, and that's likely going to be the case. Now, Bank of Japan increases the yield cap, but they are also increasing the amount of bond buying purchases that they are going to be doing. So they know that the cap is going to get hit really, really quickly, and they know that they actually have to maintain that cap by buying bonds to just not let the yield goes beyond 50 basis points. Okay, what I'm trying to say is this: the bond market and the currency market is really different. How we look at this change, or how this is like more like a sneak peek, more like a teaser to what Bank of Japan could do. This is a sneak peek. I would say this is more of a trial than anything else, just to see how the market reacts. If we take a look at spillovers on the other markets, we actually don't see a significant spillover. All right, this is only contained within the yen crosses, because I can show you the Euro USD and the Pound USD. It doesn't actually have that much of volatility. So questions I've been getting today is this: is the Japanese yen going to gain strength going forward? The answer to that is yes. Is it going to be like a significant gain like yesterday? The answer to that would be no. Okay, this happens during a period where the market is winding down for 2022. Other central banks are done with their monetary outlooks, economic projections, monetary policy announcements, inflation results, or all of them are done. In fact, I just talked about this on Monday's session. There's nothing else unless we have a sudden surprise like so. So for those that maintain a short position on yen, the question that I keep getting today was like, hey, if I were to hold my short position on the Japanese yen, does it go to 120? Does it go to 125? At this point in time, it's actually probably not. Okay, we're probably not going to be seeing a significant drop unless we really, really loses the 130 level on the daily time frame. This one, if we lose this, then yeah, it still doesn't drop down to 125 because it's more of a staggered drop to the downside. We've got 128, 126, 125, right? But if we take a look at where it is right now, and this is basically the level I've been warning you guys about for months. If it dropped down below 135 this week, what I said was that it would just go to 132. That was on the context that there's no weird announcement from Bank of Japan yesterday. What happened yesterday pushes the daily chart below 135 and immediately closes below 132. So swing traders wouldn't actually be able to catch this trade. Now, a lot of people are actually going to be looking at this and say, you know what, I missed out. I didn't jump in on 135. Some of you guys probably jump in on the euro yen, but for the dollar yen specifically, we were looking at 135 as a support. Now we broke that support. We find support, a little bit more support right now, around 130, 135. This was also the range that was established below 132, but it's actually not even below 131. Okay, so what's likely going to happen with the dollar Japanese yen? There are obviously going to be two scenarios here. There's actually three, but I'll tell you what I think is likely going to happen, right? Some traders are probably going to be looking at a potential bounce towards 135, right? This one eases off, market calms down, it gradually moves up to 135. That's scenario number one. Scenario number two, this one breaks below 130 and then continues down lower. Okay, that will be scenario number two. The third scenario is that price could just go like that, at least until 2023, or at least in the next 1.5 weeks, right? So I'm not here to tell you what's likely going to happen because we are pretty much at that turning point right now. We already lost 135. So clear indication is that, yes, we are going to see more of a stronger yen, but does it necessarily mean that we're going to see a drop like yesterday? Probably not. Okay, so take that into account if you are, if you just thought, yeah, you know what, I just jump in on the short. I don't really want to get out. If you guys were short and you managed to catch this short, maybe scale out, start moving your positions. Start adjusting your stop losses to break even, lock in some profits or whatever. But don't just hang on to it without any particular reasons. Because I think this is a really significant drop at this point in time. So yeah, you guys need to be a little bit more cautious. All right, let me go through the questions. List 50 minutes. Let me explain what's going on with the Bank of Japan and stuff like that. Hopefully you guys get that. Welcome back. Thank you. I mean, it's you guys too. It's good to be back. It's been a good week and boring without me around. It wasn't boring or anything like that. It's kind of the end of the year. It's winding down a little bit. Hope I had a great break. Yes, I do. Screen is too much brighter. I'm pretty sure I can control your brightness from your side. Maybe possible to put sell stop in the low. Thanks on the Doyen. Just be a little bit more cautious on this one. With all its fundamentals on the Japanese yen bond and so on, is it wise for me to stay out of the Japanese yen pairs for now, no matter what the technical is saying? No, Dayo, I would actually look at this as more of an opportunity, and it gives us a little bit of an insight into what Bank of Japan is going to be doing, right? Because they've been keeping quiet for the whole 2022 while the whole world was raising interest rates. They just kept mum on it, and they only adjusted the yield cap. They only enforced the yield cap, but nothing much. So this is more, as I said, more of a baby step, right? It gives us a clear indication that Japan's Bank of Japan monetary policies are slowly changing. I don't know how quick it is. I'm not sure if it's going to wait until April before they do a major pivot away, because I wasn't expecting this. I think a lot of people were talking about it, all right, but everyone was like thinking, Governor Kuroda is stepping down. I don't think he would do anything weird to the monetary policy, but hey, this is what it is. It happens, right? This is apparently anticipated by the Ministry of Finance since last July. So they do know that the yield cap is not going to be there forever. They do know that 25 basis points yield cap is not going to be there forever. It's just that no one expected this to happen this week. I'll be honest. I spoke to my colleagues, right, other analysts, and everyone was looking like around March, April. That's where we look at a potential shift. So this, should you stay away from it? I wouldn't say so, because this is basically, look, let me put it in the simplest form, right? This is like FOMC saying like, hey, we are going to taper, right? We're going to start tapering and eventually start interest rate hikes. So this is the way Bank of Japan is trying out how is it before even tapering. How's the market reaction going to be? So this is going to be intense. I think a lot of carry trades are going to get unwinded. Again, I thought this, 2022, I thought it was the beginning of a great carry trades. Obviously not with how Bank of Japan is going to be doing right now. So yeah, I think, no, you shouldn't stay away from it. I think take a look at this and see it as an opportunity, because we have an established range. We kind of know what Bank of Japan is going to be doing, what they're intending to do. They don't actually intend to strengthen the Japanese yen by any means. They just want to stabilize the bond market. That's pretty much it. Got nothing to do with intervening in the Forex market. So the way I look at this is this. There was a shock yesterday, and I don't think there's going to be an aftershock. Okay. So maybe the earliest comparison would be what happened in October when the Ministry of Finance started intervening in the currency market to, prop up the Japanese yen, right? Saw a little bit of a shock there, but eventually it stabilizes, continues to go in one direction. So I think for this one here, it was a shock yesterday. This is all right. I think this is okay. It's just one day. We don't see any follow-throughs today. This is a step towards normalization in Bank of Japan's monetary policy. So, yeah, is it going to strengthen over time? I think it might, all right? But not because of the yield cap that was increased by Bank of Japan. So there's a misconception here. A lot of people think, like as I say, the Japanese yen is going to get stronger because Bank of Japan is going to move away from, an ultra loose monetary policy. And the yield cap yesterday, that jump up from 25 to 50 basis points, not really the trigger for it, right? It's more of the thought that, yeah, Bank of Japan is doing something. They are going to be doing something in 2023. Prepare yourself for it. That's the way we look at it. The announcement came out yesterday. I showed you the cap right now. So if I can go into the hourly time frame right now, and if you take a look at where it is, it's basically stuck at 50. All right, stuck at 50 basis points. Now, if it's stuck at 50 basis points, how much further can the Japanese yen strengthen? And the reason why I have the Japanese yen there at the bottom is just to give you a comparison between the two of them. And the last time it was around 50. So we can actually see a huge drop in the bond yield, and the Japanese yen actually drops with it, right? This is to show you that it's actually it's actually wrong to think that yield goes up, the Japanese yen needs to get stronger, yield goes down, Japanese yen needs to get weaker and stuff like that. It's not like that. Okay, so because if we take a look at this, by that logic, then we should see more of an inverse relationship between the two of them. But what we saw when it dropped down below that 25 basis points, basically around 2015, 2016, is that the dollar yen drops as well. Logically, the dollar yen should be going up, right? Because what we're looking at is the Japanese yen strength. So the yield goes down. The Japanese yen back in 2015, 2016 actually gets stronger. Okay. So this is one way to look at it and say, hey, you know what? That's not the right way to look at the bond market and the currency market. That's not how it works. Okay. So if we take a look next on what's been going on for 2022, we've got the yield cap at 0.25. We actually see the dollar yen goes up. All right. So let's take a look at this one here. So starting from March. All right. So the dollar yen goes up by 26.5 yen. So the Japanese yen actually weakens by 26.5 yens when the cap was actually flat at 25 basis points. So what I'm trying to say is this: the dollar yen getting lower right now, while the yield is capped at 50 basis points, has got nothing to do with each other. That's pretty much it. It's really more of a shock. It's really more of an unwinding in terms of the carry trades, because a lot of traders were expecting, worldwide, if we take a look at the US, they were hiking interest rates. Interest rate is higher. ECB, European interest rate was higher. The UK sterling interest rate was higher against the Japanese yen. It's a suitable environment for a carry trade to happen, right? So a carry trade is basically if you take two currencies, all right, and you borrow from Japan, you invest it in a country with a higher interest rate. That's how you earn money through carry trades. I think a lot of people were kind of shocked, right? And they started unwinding because this is an earlier step than what everyone was expecting. So there was a sense of determination by the Bank of Japan that they're actually going to be moving away from their ultra loose monetary policy. Okay, so that's done. Okay. All right. So this is the dollar Japanese yen. Let's take a look at the Euro USD. It's unchanged. It's pretty much flat, right? It's not really, there's no spillovers onto the other market. We take a look at the Euro USD. We saw a significant drop on the Euro Yen, but it's not really impacting on the major currencies. It's really more contained onto the yen crosses. So oil market picks up a little bit, but I don't really see that as a contagion that the US dollar is getting weaker and stuff like that just because the dollar yen drops significantly. If we say that, then the euro yen does drop significantly as well. The euro is pretty flat. it's pretty stable. The pound USD, the pound yen also dropped significantly. The pound USD was pretty much okay. It's still within reason, right? We still got our support at 1.2050, 1.2. It does get pulled down a little bit, but not significant. Okay. As I said, I think we are heading towards the end of the year. Liquidity is gonna dry up. Volume has already started to go down this week. So if we compare the volume from last week and this week's trading, on the equity market, I think we are down about 20-30%. So yeah, that's just gonna get worse next week. All right, RSI settings, it's actually 14. I don't change my RSI settings, right? It's just at 14. Okay. Hi, Daniel from Benin City. Come to Euro USD fast. Okay, let's take a look at Euro USD. All right. So we can come back on the yen or any yen crosses if you have any positions on that. I know from Monday's one, I think on the Euro yen, I think someone actually closed out on that one. On the Euro USD, this was from Monday. We're looking more of a range breakout. We're not looking at any range breakout. This is on the hourly time frame. We have an established range, and that's the blue box there. It's still contained. Do I prefer a long or a short? I was looking for more of a short on Monday, but this is so flat right now. It's super flat. In terms of whether or not it's actually going to be, trending, I doubt this is going to be trending. We would actually be contained within this range between 1.05 to 1.07. Right now, we are trapped in a smaller range. It was actually a rectangle, but right now this has shifted into more of a triangle. I would still keep the rectangle though, because the range is just too small. Okay. So what do I prefer on the Euro USD? I still prefer a short on the Euro USD just because the risk reward ratio makes a little bit more sense. This was on Monday, but right now, if you are thinking, yeah, I do want to trade long on the Euro USD, I don't think we have the momentum behind that. Just from the RSI, we would know that the stochastics was pretty much capped at 60. So I can actually draw 60, and that's basically the cap on the RSI. We're not really progressing above 60. Therefore, we need to take a look at that as a potential resistance. The stochastics is still pointing to the downside. It's super flat. So we are really in a flat market for the Euro USD. The way to navigate the Euro USD is pretty simple. Just trade within the range, and you should be okay. That's the range that we were looking for. If you were looking for a potential breakout, there are potential smaller range that you can actually trade with. Yes, because the range gets smaller every day. The only issue that I have here is the lack of volume in the market. What I'm afraid of is that, if it does break a certain range, the smaller the range is, if it does break it, we don't actually see a follow through, because if it does break below 1.06, right, it's still going to find support pretty much at around 1.0575. So 25 pips here and there. If that's your trading style, then go nuts with it. You can trade on the 50-minute time frame as long as you have an established range. That's completely fine. But if you are more of a swing trader, I don't think it's ideal to just jump in blindly like that until we at least get out of this small blue box here. That range, it's not huge at all. We are looking at about 80 pips of range, so we just need to get out of that. See, the reason I don't like this one breaking to the upside is that we actually have a resistance at 1.07. That's why I prefer for this one to break lower. At least there's more room for it to go. It could go to 1.05. Now, if I were to zoom out, all right, we've got the established range 1.05, 1.07. Take a look at this. This is what I'm anticipating at least until, first week of January. This is still going to be the established range for this one. Hopefully there's no sudden spikes or anything like that. But if there is, then yeah, it either needs to go above 1.07 or below 1.05 for any, for any significant push out of the current range. So right now, super fat on the Euro USD. On the Pound USD, this one is progressing even better. This was on Monday's trade. So this one here, you have a couple of projections. If you were short on Monday on the Pound USD, then I think it's time for you to start moving your stop loss to break even. All right. Do you think break even? The break even would be, yeah, around, I would say you can move it to 1.2150 if you want to, just to lock in something. I think we are on track towards 1.2050 at least. Not really sure on 1.2, but that would be your second target. Your first target would still remain at 1.2050. If you guys are thinking, you know what, should I jump in short on the, I'll get rid of the RSI first. Should I jump in short on the Pound USD today? If you do, then your stop loss would need to be around 1.22. Okay. And your initial target would be at 1.2050, or you can go for what, that 1.2. If you go for that 1.2, it's going to give you about 1-to-1 risk reward ratio. But again, that's going to be second target for those that came in on Monday session. So, should you? Yeah, I much prefer to go for a short on the Pound USD more than anything else at this point in time. In terms of intraday, I think we need to break below 1.21, at least on the hourly time frame. We need to maintain below a position below 1.21, and then it'll gradually go down within that 100 pip range. But that's pretty much it. Nothing much on this one. So still looking at 1.2050, potential towards 1.2, but yeah, that's on the Pound USD. Can you do a US session breakout on this one here on the 50-minute time frame? Yeah, I think we could do that. But in terms of range, we might find a little bit of a resistance first. It should not exceed 1.2150. Okay, so as long as it doesn't go above 1.2150, the market can pull back towards 1.2150 until tomorrow morning. If it fails at 1.2150, then I think that's more of a cue to go short again on the Pound USD. But again, look, choice is yours on this one here. If we do have an hourly an hourly close below 1.21, then yeah, I think we could be looking for more of a drop towards 1.2050 first. All right, so that's your USD, that's the Pound USD. Oil. All right, so let's talk oil. Do I have any progress on oil? I don't. Sorry. So my cue for oil, I'm not going to rush into oil. I don't think we need to rush into oil. Talk about this on Monday. I didn't bring this up on the outlook, but basically I want to see a position above at least 82. Right, I want to see a close on the daily above 82. That would shift this above the Ishimoku cloud. Then that would be more of a green light for me. But until that happens, not really the time to jump in on oil at this point in time. We do see a little bit of a base around 70. No inputs, no news whatsoever if the US government actually refill their oil reserve at 70. But it's more of a psychological level rather than anything else. So we do see that bounce from 70, 72. And yeah, right now it's pushing up higher, but I don't think this is quite time for any long-term positions on oil, at least not from the daily time frame. If you're looking at it on the hourly time frame, can you trade oil to the upside intraday wise? Yeah, I would guess so, but just be a little bit more cautious in terms of your target levels and stuff like that. Because if we go by fibs, I believe this would be the fib for the hourly time frame, very very close to 127.2, just slightly above 78 on oil. All right. How far can it go up to? It's still going to be contained below 80 at this point in time, so you might be looking at around 79.50. But that's pretty much it. It's momentum for oil. Is it to the upside? If you have a long position on this one, I would say yeah, hold on to it. That's completely fine. Just adjust your stop losses. If you're thinking, you know what, I want to jump in on oil right now, I want to go for that 161.8%. This is going to be your minimum stop loss. Your stop loss needs to be around 75. Right? Risk reward ratio, probably not 1-to-1, but that's the minimum stop loss, right? The ideal stop loss would be at 75. So choice is yours on this one here. But this is the current trajectory on US oil. I think we're very close to 127.2. I think without a doubt we might actually be touching 127.2. It's not really that far from at this point in time. It's just that from a risk to reward standpoint, it's going to be tough unless you're really jumping in without thinking about the risk, which is not really my style at all. But yeah, can you find a small stop loss on this one here? Think about it. If you want to go for that extra there, yeah, is there a little bit of a room? Yeah, but don't get too aggressive on that one there, because it's at least on the 15 minutes time frame there, it might actually pull back down a little bit. Okay, so right now I think we are going to be looking at a move towards at least attempting to break 78. Is it going to break and maintain a position above 78? That's to be seen when the US market kicks in. But again, let me just remind you, volumes are dropping down. We've got reduced liquidity, we've got reduced volume, so any exaggerated movement on the market is potentially possible. Christmas will crash again for Bitcoin. Not sure about the correlation with Christmas on Bitcoin, but I think for Bitcoin, I'm not sure if I discussed it here, but just to give you a look on Bitcoin, let me just remind everyone what's going on with Bitcoin. So pre-pandemic hype, right? This was the pandemic hype. Pretty much there, right? Okay, where we are right now, it's actually pretty stable. If we take a look at the range here, this was how and where the Bitcoin market should be operating in, right? We are not even supposed to be looking at 64,000 on Bitcoin. I think it was really more hyped up than anything else. So whatever the hype was, it was pretty much gone. FTX doesn't help either. So yeah, I think we are looking at a lot of people losing interest on Bitcoin at this point in time. Is it going to crash further? Are there room for it to crash? I'm potentially detecting a little bit of a divergence here. I think it's not really a matter of what's going on with the exchanges and stuff like that. I think it's more about if there's actually any demand for Bitcoin. That's pretty much it. Is it stable at this point in time? I think 15,000, 16,000 for Bitcoin is a stable price. Do we see a drop towards 5,000, 10,000? Probably not, unless more details comes out on FTX or maybe other exchanges, other major exchanges suddenly have any issues. Then yeah, we might see a collapse based on that. But other than that, no. I just don't correlate any fundamentals to cryptos, because it kind of defeats the purpose of cryptocurrencies, as I always stated. Right? I thought the purpose was to be decentralized, and the whole FTX thing is like, hey, we want more, regulation on Bitcoin. Will I be able to open big position in Forex market as liquidity will drop because of Christmas? Is it necessary for all open positions to be closed before the holidays? So yeah, look, this webinar is basically the last webinar before Christmas, right? We got Christmas over the weekend. And then next week, we still have a session next week before the year ends, but let me explain a little bit. When the liquidity dries up, It's kind of normal to see spreads widen, right? Do you have to close all of your positions? Probably not, but just be concerned about liquidities, right? Where you're trading right now with OctaFX, I don't think there's going to be an issue with liquidities, right? When we talk about drawing liquidities, drawing volumes, volume dropping, liquidity dropping, what I'm trying to say is that there's less market participant in the market. Doesn't mean that your liquidity provider or your broker is all of a sudden gonna increase the spread from 1 to 2 pips to, let's say, 10 pips. I don't think that's going to be the case. So I'm not too worried about it. Can you open big positions in the currency market? Yeah, I mean, why not? I don't see the problem there. It's just that you might not see a lot of volatility in the market because of reduced volume, reduced liquidity. Okay, so no volatility means a flat market, and a flat market would be something like the Euro USD right now. Okay, so just think about it. I wouldn't expect significant, breakouts or anything like that at all. With the stochastics going down, how far can it go? 1.05, it's really a huge distance. If you take a look at where we are right now towards 1.05, we're basically just halfway on it. If you open a position and hits your take profit caused by whipsaw from news that you don't predict or calculate, do you count it as a successful trade? Yes. But you need to put a note on your journal. Why was your take profit hits? What happened, right? You need to jot it down. Is it a successful trade? Yes, I think it would still be classified as a successful trade. Is it an intended successful trade? Probably not, right? But that's why you need to just record what happened, for future reference. At least how to actually prevent it or use it to your advantage again. So, and that's the reason why I said earlier, I think Dio was asking me a question, right? Should I stay away from the yen crosses? I would say no. I think it's a great indication that the Bank of Japan is doing something, because if they started increasing the yield cap again, then we know the first market that's going to react to it would be the currency market, especially the yen crosses. So I guess a lot of new things has happened in 2022. Hopefully you guys learn a lot of stuff on this one here. We saw what happened with the war, the intervention, the whole inflation going crazy, interest rate going up. So I think it's probably new to a lot of traders right now. Okay. All right. For this 2 years, great advice from you. Get more safe trade and huge gain percentage from your strategy. I hope God bless you. Thank you so much. God bless you too, man. Look, I just want to help out, right? Not really looking for anything like that. So any questions that you have, more than happy to explain, more than happy to help out. At least, I can help out with explaining what actually happened yesterday. So in the future, if you read up on anything Bank of Japan related, you know that they're not really doing anything. They're starting to do something. So I think it's a great indication. I think it's a great direction. It's just that the message wasn't that clear on what their intent is, but that's pretty much it. Right, so because everything is pretty much flat, let's take a look at the 10-year yield first, right? I think next week, I think we will be doing a session on how to actually read out in a recession and stuff like that, and we are actually going to dive deeper into the yields here. But 10-year yield right now, if we say the US dollar is going to get weaker and stuff like that, 10-year yield is still about 3.5%. The dollar index is being pressured a little bit, so we were looking at a potential return towards 105. We actually saw price gets back close to 105. Is it dropping down significantly at this point in time? It's not. So even after the Bank of Japan shock yesterday, we're not really seeing a significant drop. So, I was reading up, people were talking, people were texting me, the dollar is going to get weaker and stuff like that. If the dollar was to be weaker because of what happened with Bank of Japan yesterday, it would be below 103 at this point in time, at least on the dollar index. So just to give you a little bit of a perspective, we actually still have a pretty flat market despite what happened with the dollar yen. Great learning experience for my first year in trading. I mean, 7 months of trading. You're doing great thing right now. Absorb as much information as you can. I would say for your first year of trading, just keep an open mind. Don't be too focused on getting there overnight, right? Don't buy into that. This is more of a gradual step. I think that if you look at it, 7 months. I think we started our webinar series about 3 months ago. So about half of your trading, I've been feeding you some stuff for you to actually pick up and learn, right? So I think it's a great start for you. Okay, so yeah, I just want to highlight we are not looking at a very, very volatile US dollar at this point in time. So don't fall into the misconception here that the US dollar is going to crash and stuff like that. Okay. So the comparison I think a lot of people were looking at was gold as well. It was gold gaining, was gold breaking out of range and stuff like that. With gold, this let me bring this up. So was it this one? Yeah, it was this one. So this Fibonacci, excuse me, I'm not sure if I still show it on the Outlook on Monday, but we were capped at 161.8%. We basically have a technical resistance at 161.8%, which is very close to 1825. So if you're thinking, right, you're going long on gold because of what happened with the news yesterday. We saw gold picked up a little bit. We saw a little bit of a drop there. Run to safe haven. Whatever the reason is, people are going to tell you. Look at it from a technical perspective. We actually are still within range, right? We have a technical support at 1795, and that's basically still intact. That's where price bounces off from. We are still capped by 1825. So if you are looking for a trade intraday, that this is going to be established range. Do we see a significant drop? Do we see a significant drop below 1795? Probably not. Do we see more of a potential gradual push towards 1825? Once the momentum crosses over, that I would say yes. But do I look at anything beyond 1825? Probably not. Not at this point in time. So if you're thinking if you want to go in for a long position right now because you want to go for that 1825 level, right? Think about it. If you place your stop loss here, it's going to be too close for comfort. Okay, you would need to place it below 1800, which is going to take the risk reward ratio off a little bit. So unless you have a long position on gold, then yeah, you might want to hold on to that trade, but move your stop loss to break even. And then go for 1825. If you are thinking, you know what, I definitely need to jump in on a trade for gold right now, then I would say make sure your stop losses are about 1810. That would be really the bare minimum for gold. Okay, I'm not into trading gold on the 50 minutes. I'm not into trading gold for 2021, 2022. So if this is your taste, then yeah. If there's a close, at least on the 50-minute time frame above the Ishimoku cloud, then we actually potentially could see a little bit of that nudge towards 1825. That would be the higher probability. I'm not looking at a potential short at this point in time because if there is a short on this one, there's a lot of support to the downside. Okay. Scenario number one is that. Scenario number two is if we lose this floor, this is really, it's got no significance to it, right? If we drag it up, you might see, yeah, you know what? It used to be something, but it's not really at a whole level or anything like that. We have 1812, right? So if we do see a break below 1812, then you might want to take a trade to the downside, but your stop loss would be above 1820. It's not really a significant support at this point in time. So this doesn't necessarily mean that there's enough momentum for this one to go down significantly towards 1800 or anything like that. So think about it. Probably not going to be the case. So this is what we are looking. This is normal. This is pretty normal at the end of the year to see this kind of movement in the market. We either get an exaggerated movement or really a flat market. That's pretty much it, right? But that's pretty much it for gold. I don't have anything new for gold because we don't really establish anything new. We've got an established resistance at 1825. We've got an established support at 1800, 1795. We're halfway there. If it does break below 1812, 1810, then yeah, you might want to trade within the range. So in terms of looking for positions on gold, I would really focus on 1810. All right. If you're an intraday trader, I would really be focused on 1810. If we have an hourly close below 1810, then you can trade to the downside, probably towards 1800, but make sure your stop loss is what it's at, whatever high it is right now. So it would be something like this, right? Risk reward ratio probably not going to be 1-to-1 initially, but that would be it. If you're thinking you want to go long, then you can aim for the 1825. If you're thinking of shorter stop losses, then yeah. Intraday stop losses, and I would probably go for this stop loss. If you're thinking of going long right now, I probably wouldn't want to have a stop loss that's too big. You can go for, don't go for 1825. Go for 1824, at least to 161.8%. All right, this is going to give you an okay risk reward ratio. Some of you probably like this trade. It's just that it's too close for comfort in terms of stop loss. But yeah, this is the minimum stop loss. Okay. All right. Moving on. So there's a question. We know that Euro USD has been side. If we expect US dollar to get stronger, is it okay if we short it around 1.065, 1.066? So you want to short on the upper range when it get rejected? Yeah, so you want to see price goes there, and then you want to short it there within the range because you know that it's an established sideways market condition. I would say that's actually not a bad idea. It's just that this is a range bound market, right? So technically, if you short closer to resistance within that box, I would say it's okay, but make sure your stop losses are about 10675. Okay, that would be okay, right? In terms of target level, don't go crazy, don't go to 1.06 or stuff like that. Go for 1.0650, 1.0625, just to the middle of the range. And then you can extend it lower if you want to. That's completely okay. I think that's going to give you a great risk reward ratio. Just don't risk more than 50. Because here's the logic. If you're shorting it there and you have your stop loss at around 50 pips, right? That's going to take you above 1.07. If you have your stop loss like that, then why not short it closer to 1.07? That's the logic behind it. If you really want to short it at around 1.0660, just make sure you have a tight stop loss. Don't go crazy on your stop losses. Because you are trading based on an assumed resistance, right? So with the assumed resistance, therefore we assume that price shouldn't go higher than that resistance. That's kind of the logic behind it. Okay, pretty quiet, everyone. Okay, so let me touch base on the yen crosses again. So with the euro yen, I think there were a question that was actually a request for this one here. So there's a lot of lines on the euro yen. The reason why I didn't get rid of those lines because they are still important. I can clear some of them, but I would still keep 139, 138.50, 138. The rest of them I can clear it off. I would leave 135 to the upside. I would keep 142.50, 143, 143.50. Yeah. This, I wouldn't worry about it too much. All right, there we go. Clean it up a little bit. So with the euro yen, the reason why I'm not too keen on saying that the yen is gonna, it's gonna move significantly stronger again. Today we have a quiet market, right? Maybe it's a period of consolidation, but if the Japanese yen is actually going to get stronger, then at the very least, I should be able to pick up some hidden divergences. I'm not picking it up. At the very least, I should be able to pick up a bearish flag. I'm not picking it up on the euro yen. All right. So I need to be a little bit more careful on this one. I think a lot of traders got trapped on the yen crosses because they were following the drop in the dollar yen yesterday. I think they were shorting maybe around 141 or below 141, and right now you're kind of in between, not really going to a target but not really hitting your stop loss either. So I think a lot of traders are actually trapped inside this right now. So until we actually see a significant breakthrough on the euro yen, when we say significant breakthrough on the euro yen, that means I would need to see a confirmed close below 139. If we have a confirmed close below 139, then yeah. And if we work based on that assumption, that would mean this is the current range on the euro yen, at least on the early time frame. Okay. So do you go short right now on the euro yen? You could go short right now on the euro yen if you want to, but your stop loss would be about 141.25. Is it worth it? I don't know. Okay, so I'm probably not for that kind of short on the euro yen. So what I'm trying to say is a lot of people are trapped within this range right now on the euro yen. So until we see a significant breakout, then yeah, we're not looking at anything on the euro yen, because technically the reason why I don't want to short this at this small range is this. If there's a break out of this range, price could actually pull back to 142 on the euro yen. Okay, so either trade that pullback if that happens. So if you're using stochastics needs to turn. If it does break above 140.50, then that's where you want to go in for a long. You can actually trade that short bit of correction towards 142, and risk reward ratio would still be, yeah, it's not even going to be 1-to-1, but hey, it is what it is, right? About 1-to-1 risk reward ratio. But again, let me remind you, it looks small, but that range itself is around 170 pips, right? That's 1.7 yen. It's significant. Thank you. Quiet market in 2 weeks before holiday. Not going to trade until next year. What is the best? Which is better, naked chart or indicators 8? Naked. I prefer. It depends, right? It's hard for me to not think about momentum and volatility in the market. So that's the reason why I use indicators. But if you're not a short-term trader, if you are, more of a, set your target and stuff like that, you're okay with bigger risk, then I would say go naked without any indicators, because it's actually a lot easier to look at the market if we go naked. So let me give you an illustration if we go without indicators or anything like that. Okay, so I'm going to close it up. I got nothing. So this is on the Euro USD. Let's go into the hourly time frame. If you go naked on this one, It's basically this. You're only going to be working on this range. So if we see a breakout out of this, then you would want to go long, have your stop loss there. In terms of target levels, we're basically looking at previous resistances, what's capping the market. Take a look at this one here. That's basically around there. Then you adjust your target, and that's pretty much it. That's going naked, right? I don't have any indicators. Do I have any clear direction for a potential breakout? Yes, I do, if it does break that level. But without indicators, without thinking about the volatility and momentum in the market, you're going around the market with one eye closed. Because at this point in time, where we have low volume, low liquidity, I think it's really key to understand if there's actually any momentum behind any breakouts. Simple as that. If you're using a risk-reward ratio of 1 to 20, 1 to 20, 1 to 20, it's always going to be okay. And 1 to 2 is it's okay. 1 to 1 it's not okay if you go naked on this one. In Forex and limitations on opening lot sizes at a time or day will get open and get liquidity. Look, as retail traders, our lot sizes are really, really small, right? People are trading yards there. It's like billions in terms of lot sizes. So yeah, is it gonna get filled? Yes, it's gonna get filled. Is it gonna get filled quickly, even with low liquidity in the market? You don't have to worry about that. That's all I'm trying to say. What I'm trying to say about low liquidity and low volume in the market is because we have less participants in the market, we have more of a range bound market condition. That's pretty much it. Not saying that your order won't get filled and stuff like that. Your order, your stop loss, your take profit is going to get filled in microseconds. But yeah, don't worry about it. Okay. All right. So I hope I explained a little bit on what's been going on this week. Other than that, let me just remind you, it's actually still a pretty flat market. When we talk about the major currencies, the only exception with the currency market that has moved wildly is just the Japanese yen crosses. Okay, right. No further questions. Then we can wrap it up. We still have the Friday session. We'll talk more about trading strategies this week, and then we have next week. So even on the 30th, I'm still going to be here. Sharing on how to actually develop your own trading strategies. I think that's really key, right? So we got trading strategies this week. Next week's going to be developing your own trading strategies. Other than that, if you guys are celebrating Christmas, Merry Christmas to you all. Have a great holidays ahead. Even if you guys don't celebrate Christmas, you're still going to have a great weekend. So with that, have a fantastic time ahead. Okay? Merry Christmas, guys. Stop loss hunter thing really exists? Nah. You know what? For those that actually say that stop loss hunting exists, they're just basically looking for someone to blame on their bad trades. That's the way I look at things. All right. Merry Christmas all. Have a great break. I'll see some of you guys on Friday. If I don't see you guys on Friday, then have a fantastic holiday ahead. And I'll see you guys back on Monday, Wednesday, and Friday next week before we wrap up for the year. And then I think we have about a week's break in the first week of January. All right. Thank you all. Have a great time. I'll see you soon. Good luck with the trades. Stay safe.